Good evening, everybody. I hope everybody can hear me. So thank you very much for joining us on a Sunday evening, where we are trying to showcase in terms of our session on Introduction to Fixed Income Securities, what we are going to do next week in our course. We're trying to showcase what the curriculum is and why it's important for you to learn about fixed income securities. So my intention today, over the next 20 minutes to half an hour or so, is to talk about what is fixed income, why it's important to look at fixed income, because I know a lot of you would be looking at, definitely when you think about investing, I'm sure a lot of you would be thinking about investing in fixed deposits, right? And probably a lot of you who are here is also interested in the stock market. So maybe you're already investing in the share market as well. But not a lot of you would be investing in other fixed income based securities. So I'm Vindhya Jayasekara. I'm a fund manager who's worked a lot with fixed income securities. I have extensive experience in the treasury bills, bonds, debentures, commercial paper, as well as shares over the last 10 years. That's what I do. And I also lecture for a number of local universities. So today, over the next, like I said, over the next half an hour or so, I would want to tell you why you should look at fixed income as another opportunity or alternative investment option. Because when you're looking at investing, definitely you have to think about the long term. And this is not something that we generally do when we think about investing. A lot of you would be thinking about investing a little bit in the stock market, making some money from the share market when share prices go up, but it's not a long-term plan. And really, if you're going to think about investing, you have to think about the long-term consequences and why you're doing it and why it's important to do it. So once you look at it that way, it becomes apparent, hopefully, that you have to also look at other avenues to really grow your money and to really accumulate wealth. Okay? Because why is it important to invest long term? It helps, for example, in case something happens, it helps you maintain your required lifestyle. Okay? It helps you provide for emergencies. You have a pool of cash that you can pull out for emergencies, as well as for retirement. Now, a lot of you, I'm sure, will be in the age group of 20 to 30. So you might not even be thinking of your retirement right now, but that's a very important aspect. And even it's never too early to start thinking of what you want to have by the time you retire. Because with everything that's happening with inflation and with investment returns, you always have to start early, because when you start early, you can grow your money much more than if you start late, especially due to the power of compounding. So if I talk about, let's talk about it in terms of, the financial planning pyramid. Okay. The financial planning pyramid, sometimes experts call it the financial freedom pyramid, because it's about how you want to manage your money. What are your goals in the long term and how you want to manage your money to achieve those goals. So this pyramid, I can broadly divide it into three components: the protection component, the wealth accumulation component, and the wealth distribution, preservation and distribution component, right? So if you look at right at the bottom of the pyramid, this is the protection component. This is where you do, when you look at investing or when you look at financial planning overall, you have to think about protection. Protection means very simple things, right? You have to think about establishing a continuous level of cash flows, for example, stable cash flows. And this can simply be the fact that you have a stable job, or if you're an entrepreneur, you build up your business in such a way that you have a steady flow of cash coming in. And if not, you think about, okay, then I should look at extra income. What are my other sources of income? Am I only relying on my job as a source of income? As well as just in general, reducing your expenses, in general, reducing your debt. If you have debt in form of credit cards or in form of loans, These are things that you will think about in terms of protection and managing your money. The second layer of protection is building your safety net. And in this, when you think about building your safety net, you're thinking about life insurance, health insurance, disability insurance, all that. What is there in case something happens to me? Am I protected? Are my loved ones protected? This is something that you would want to think about. Okay. As well as this is where you start to save regularly and build up emergency funds. Okay. So this is the pool of cash where you're starting to build up your emergency funds. Okay. And this is, again, the most common misconception where people think, okay, by saving, by investing my money in savings accounts or FDs, I'm saving, and I'm not just saving, I'm building wealth. Not necessarily. And I'll show you why as we go along. Not necessarily, right? So savings are definitely important. It's that protection phase. So FDs are definitely important in that area where you want to build up a pool of money which you have for emergencies, right? As well as a pool of money that you can use to further invest. This is what we call wealth accumulation. So once you come to that next step of the pyramid, in terms of accumulating wealth, here you're looking at growing your money. This is the place that you are in right now. This is why you come for these seminars and try to increase your knowledge, because you want to know how to grow your money. And most of the time, we concentrate a lot on the stock market. There are reasons why we do that. But growth and diversification is not only about concentrating on the stock market. It's also, you can look at other instruments, like, for example, treasury bills, treasury bonds, debentures, commercial paper, other fixed income instruments, which again, I will talk about in a little bit. Okay. So in this phase, this is where you're looking at accumulating wealth. And from there, later on in life, as you grow older, you will then look at, when I retire, can I preserve my wealth? How can I preserve my wealth while utilizing it for retirement and while leaving a legacy for maybe my children or maybe for charity? So these are things that I will that you will look at. So when we talk about, I said, most of the time, if you look at investing, most of the time, most of you would think, yes, I am investing, I'm putting my money in fixed deposits, right? Yes, I am investing, I'm putting my money in the share market. So the problem is now, and more than the share market, actually, a lot of people's money would be in fixed deposits. Really speaking, the banking industry in Sri Lanka is 11.6 trillion rupee industry, meaning all the deposits in the banking system together is 11.6 trillion rupees, of which about 6 trillion rupees roughly is in fixed deposits and about 3 trillion rupees roughly is about in savings accounts. Do you know what the rates of these savings accounts and fixed deposit rates are these days? Because there was a huge drive, because a lot of people, you know, the financial literacy in Sri Lanka is very low. You might have heard that financial literacy in Sri Lanka is 33%, meaning 1 out of 3 people don't pass the threshold of financial literacy, right? And there was a huge drive to educate people about what is the return that you get when you keep your money in savings account and whether it's enough or not. But those days, interest rates were high. And those days, you received about a 5% return in your savings account. Today, interest rates have come down a lot. And these days, actually from your savings account, your returns will probably be in the range of 2.5% to 3.5%, depending on where you invest. From FD, if you look at a 1-year fixed deposit, you're probably getting, most people are probably getting the return of between 4.5% to 5%. So yes, if you have a lot of money, if you have bulk deposits, you can definitely go and negotiate directly with the bank. But otherwise, these days, FD rates are also not very attractive. Okay? And that's in general, anyway, the market interest rates are also low. So you can't say anything much about that. But the problem is, fixed deposit rates are 4.5% to 5%. Is that enough? Am I making money? That's the question here. And what is the biggest hindrance in terms of making money, one of the biggest hindrances becomes inflation, right? So when you think about inflation, I mean, what is inflation? Inflation is the fact that the prices of goods and services are going up. That's inflation. And because the prices of goods and services are going up, the value of money comes down. So if you take a look, for example, at this infographic that I've shown you, those days you could probably, maybe 2 or 3 years ago, you could probably buy a couple of burgers, maybe 3 burgers for about 1,000 rupees, right? Today, you won't be able to buy the same amount of goods for that amount of money. For 1,000 rupees, think about it from your basket of goods. What can you buy? And what could you buy for 1,000 rupees 2, 3 years ago? Prices of goods have gone up. That's inflation. And because of prices of goods going up, for the same amount of money, the amount of goods that I can buy has come down. So the value of money has come down. So inflation is something that really impacts what I earn, because whether in real terms I become richer or poorer depends on what is the inflation level, right? So what do I mean whether in real terms, whether I become richer or poorer? See, if for example, I invest my money and I make a 10% return and inflation is 6%, for example, right? I make a 10% return. So I put 100 rupees in somewhere, I invest 100 rupees in a fixed deposit or anywhere, I make a 10% return. And at the end of 1 year, that 100 rupees would go to 110 rupees because I make the fixed deposit or whatever the instrument is giving me a 10% return. So from 100 rupees, it moves to 110. Okay. If inflation is 6%, that means for that 100 rupees, 1 year ago, I could have bought a certain amount of goods and services. Right? Now, today, the same good, whatever I could have bought for that 100 rupees, today costs 106 rupees because of inflation. So really, has my wealth increased by 10 rupees? No. My wealth hasn't increased by 10 rupees. My wealth, although I got a return of 10% from my investment, I can't buy the same amount of goods that I could before. So actually, my wealth has only increased by 4 rupees. That's what I mean by my real return. Really, I have increased, or my wealth has increased by 4 rupees. Why do I say 4 rupees? 110 minus the fact that I can only that 100 rupees. Sorry, for that 100 rupees, the goods and services have gone up to 106 rupees. So to buy the same goods, I have to now pay 106 rupees. Okay. So what's the inflation rate in Sri Lanka right now? Take a look. Okay. So here I plotted the inflation in Sri Lanka over the last year and a half from January 2020, as well as the central bank even published figures of the average fixed deposit rates in the country. Okay, so this is based on what is the average fixed deposit rate. So think about it, last year. Now you can see how much fixed deposit rates have come down because interest rates have come down quite a bit as well. Okay, so beginning of January last year, we would have had fixed deposit rates somewhere around 9.5%. Now, today, like I said, so the central bank published figures here are only until June, but the fixed deposit rates are somewhere in the range of 5%, the 1 year fixed deposit rate. Okay. For different people, for different banks, this will change slightly. So now, if you look at last year, if you put a fixed deposit on average, somebody would have been able to make a fixed deposit at about 6%, 5.96%, right? So let's say that's 6%. But inflation, here what I have plotted is point-to-point inflation, meaning today's inflation based on the price of goods and services 1 year ago, right? Today, in July, the inflation is 5.69%. So July published inflation figures are 5.69%. This is inflation figures published by the central bank based on a basket of goods and services, basket of goods that they that they have estimated is used by the average person. Okay. So based on that basket of goods and your inflation has gone up by 5.69% from a year ago. That means from last July, prices of goods have gone up by 5.69%. You have invested your money and you're earning 5.96%. So really, how much has your wealth grown by? 6% versus 5.7%? By about 0.3%, which is fine. Okay, you still, at least, you've grown a little bit. But look at today. Look at where inflation is right now. Think about your inflation expectations going forward and think about what are the rates that are being offered today. Okay, so today's 1 year FD rate, like I said, somewhere around the range of 5%. Inflation currently is 5.69%, but this is historical inflation. We are concerned about inflation going forward. But when you think about inflation going forward, you think about the fact that today's inflation prices have gone up despite the fact that economic activity is not there, despite the fact that the economy is mostly not operating at full capacity because of COVID. So because of this, you're not seeing a lot of demand for goods and services, and still prices have gone up by about 5.69%. And then there is the impact of exchange rates probably going to depreciate, or different things that are happening that may mean inflation might go up in the future. So if inflation is going to go up in the future, today, if I make an investment in a fixed deposit or any other instrument at around 5.5%, it's not going to make me richer. It's actually going to make me poorer. If, for example, let's hypothetically think inflation 1 year from today is 7%. That means from today's level, goods and services have gone up by 7%. But I made my investment at 5%, right? So if goods and services have gone up by 7%, what cost 100 rupees before now costs 107 rupees. But I have only earned on my 100 rupee deposit 105 rupees. I'm actually poorer by 2 rupees. Okay. So this is why it's very important for you to look at a gamut of investments that will really help you in terms of your you growing your wealth. Because as I showed you before in the wealth pyramid, deposits are important. Deposits are essentially your safety net. So you need that to gather your regular savings, to build up your emergency funds, and to build up funds for investments, right? But deposits are not necessarily investments. When you think about long-term investments and when you think about trying to earn above inflation, you have to think of other investment opportunities. So what are the other investment opportunities that you can think of? The first thing that comes to head is shares, right? And that's the most popular instrument that's there in terms of investing. This is something that everybody pretty much knows about, especially people here probably know a lot about the share market, and you all are probably investing in the share market, right? So I showed you earlier that fixed deposits were about 11.6 trillion market in Sri Lanka. The share market right now is about a 4 trillion market, okay? And the share market is highly volatile. Obviously, shares are risky. So share prices can go up, can come down. Last year, if you look at the SPI gave you a return of 10.5%, versus the S&P gave you a negative return of minus 10%. So depending on where you have invested, you might have made positive gains, really good positive gains, or negative gains, right? So far, year to date, in 2021, share market has given about 18% return. That's all the shares in the index. That's 290 odd shares in the index. Everything together on an amalgamated basis has given 18% return. But your return depends on where you invested. So some companies have done well, other companies have not. So shares carry a very high volatility. Okay. What I want to concentrate on is the next set of investments, because you would have gone through a lot of courses, talked a lot about equity investments. I want to talk a little bit about fixed income investments. So in terms of fixed income investments, what are the things that you will think about? And what is a fixed income investment? When you think about a fixed income investment, really, it's a loan. Now, what's the difference between equity and fixed income? In shares, you become the owner of the company, right? You don't feel that you're becoming the owner because you're only buying and selling shares of the company. You never realize that you actually own a part of that company. You are a shareholder of that company, right? So when you buy a share, what is happening? You are proportional owner of that company. Versus in fixed income, what are you doing? Whatever type of fixed income you're investing in, you are actually giving that company or entity a loan. Okay. So what are companies doing? We call them issuers. Companies who come to the market and borrow in fixed income in the form of commercial paper, debentures, treasury bills, bonds, whatever. We call them issuers. So what are these issuers doing? They are coming and asking us, you and me, for a loan. So when we give them money and make an investment, we are actually creditors to the company or to the government. If we are giving the government a loan, if we are investing in treasury bills or bonds, to the government. Okay. So fixed income instruments or fixed income investments in that sense is essentially a loan that we give, a loan that the company takes. So because of this, most of the features of fixed income securities also fall just like a loan. Meaning what? Meaning in a loan, you know, when you take a loan, when you take a car loan or when you take a housing loan or a personal loan, any type of loan that you take, you know that you have a repayment period for this loan, right? There is a fixed maturity. So if you take a loan, you will take a 5-year personal loan or a 10-year housing loan, right? So there is a fixed maturity for that loan, a fixed period of time that you have to repay. In shares, there's nothing like that. A company, until it's there as a going concern, the shares will be out there and you will be a shareholder, or you can be a shareholder of that company if you choose to. In fixed income, there is a certain period that the company is borrowing money from you. And after that period, after that period, the company will pay you back. Okay. And just like a loan, there is a interest rate that the company will pay you. Because when you take a loan from anybody, if the company goes to a bank and takes a loan, he has to pay an interest on the loan, right? So just like that, when the company comes to the capital markets and asks us, you and me, for a loan, the company will also pay us interest. So fixed income investments, most fixed income investments will carry some form of interest. And long-term fixed income instruments, like, for example, debentures, securitizations, treasury bonds, right, will have interest in the form of, they will have a regular interest payment. And this interest payment in loan terminology, or sorry, in fixed income terminology, is called coupon. It's called a coupon. Now, I don't know if you know why it's called a coupon. Actually, it's interesting. Think of what you know. Don't think of fixed income. If you all know what a coupon is, right? A coupon is what, in real terms, a coupon is something that you would tear off the paper that says, present this coupon to the cashier and get a 10% discount, right? You've seen these coupons in papers where you can tear it off, go to the store and buy something, and you will get a discount, or you will get something when you present the coupon. It's exactly the same thing that happens in a fixed income instrument as well, right? Because those days, unlike today, fixed income securities, they were pieces of paper, right? Pieces of paper that was an agreement to pay you, to pay the person back, right? So I take a loan. Let's say I take a loan from you, and I give you a piece of paper that says, I have taken a loan from you and I agree to pay you back in 5 years' time. Okay. And until that 5 years expire, I agree to pay you an interest of this much every whatever frequency, monthly or quarterly or semi-annually or whatever, right? So how do I know, or how do you know that this interest has been paid? Generally, what happened in those days, historically, was this piece of paper that was given to people had a set of pair of coupons, little tear off pieces of paper, where you can take that piece of paper to the bank, present it to the bank, and then the bank will pay you the interest. That was why it was called a coupon, and that name is stuck. So still yet, all of these instruments pay coupons. So when we talk about fixed income instruments, we don't talk about interest. We talk about the fact that companies will pay you a coupon rate. What is that? That is the rate the company pays you on its borrowing. And why is the coupon rate important? Coupon rate is important because the return that you get from investing in fixed income can be different from what the company pays you. Now, I don't want to go into that too much. These are some things that I will talk about more in detail when we do the fixed income course next week, right? So there is a difference between the return or the yield that you will get when you invest in a fixed income instrument versus what the company pays you as a coupon. Okay. So when you think about fixed income instruments, I've just broadly categorized it. You can have different types of categorization. I've categorized it as fixed income instruments issued by governments, which are essentially treasury securities or government securities, as well as fixed income instruments issued by companies or banks, corporates, which is corporate debt, right? So within treasury securities, you can have short-term fixed income instruments, meaning the government can borrow short-term money. Short-term means less than 1 year. So he takes a loan, the government takes a loan for less than 1 year. These loans are called treasury bills, right? And when the government borrows money for more than 1 year, there are certain features when they come to the capital market and ask for money for more than 1 year. These are called treasury bonds. And treasury bills and bonds remain one of the most liquid markets in Sri Lanka, even more liquid than the share market, right? You can see the share market is a 4 trillion market. The treasury bill and bond market is an 8 trillion market, right? Of which 2 trillion is in treasury bills and 6 trillion is in treasury bonds. And you can see treasury bills these days. Now, treasury bills, treasury bonds are issued by the government. So because they're issued by the government, they are default risk-free. Why do I say default risk-free? Because technically, even if the government runs out of money, they can print and pay you back. Right? So because of this, it's generally accepted that treasury bills and treasury bonds are default risk-free. Okay. And default risk-free, these bonds will give you returns of 5 to 5.28%, depending on whether you're investing 1 month or 1 year. And treasury bonds, there are treasury bonds that are available up to 25 years right now. So that's the 2045 maturing bond. And that gives you a range of returns from about 5.5% to 8.99%. Okay. So depending on where you want to invest, there are different options available. And you can see now you have opportunities to invest over and above your expected inflation rates, right? So treasury bills, treasury bonds, though are default risk-free. So because of this, they are safer instruments. Because they are safer, the interest rates are also slightly lower that you get from these instruments. Versus once you come towards corporate debt, these are companies that are borrowing money from the capital markets. So because companies will be in different entities, it can be banks, finance companies, or any other company in the market, right? So when companies borrow from the capital markets, there is a default risk, meaning there is a company, let's say, for example, a company can't borrow and suddenly if they run out of money, they can't print money and pay you back, right? So there is a risk probability, no matter how small it is, there is a probability of default. So whether you invest in FDs or whether you invest in corporate debt, there is a probability, no matter how small it is. It can be a very small probability, but there is a probability of default, right? So because there is a probability of default, these instruments offer higher interest rates. higher returns, really speaking, higher returns, higher yields. So if you look at short term, so I've divided this again, my corporate debt, I've divided into two broad categories. I'm calling money markets and capital markets. Actually, treasury bills are also money market instruments. It's just the way that I've shown it here in my categorization, right? Because I wanted to show government securities separately and corporate debt separately. But treasury bills are also money market instruments. But within corporate debt money market instruments, you have things like commercial paper, promissory notes, bankers' acceptances, repurchase agreements. So these are different instruments that you will have. And commercial paper these days, depending on whether you're investing 3 months or 1 year, and depending on the riskiness of the issuer who is borrowing the money, you can get returns of up to maybe in the 1 year level, 8 to 10%. Okay. So that depends on the riskiness of the issuer, that depends on a lot of things, but you can see that the returns are higher than investing in treasury bills and bonds because there is a risk associated with it. Okay. As well as when you go towards long term, so in long term instruments we call capital markets. So again, under capital markets, we have treasury bonds also fall under capital markets, as well as shares. Shares are also capital market instruments, but both of these I've just shown separately. I'm only showing capital market corporate debt securities here. And you can see under capital market corporate debt securities, you have things like other instruments like debentures and securitizations and so on, right? And from these, because now you're looking at long-term instruments like 3-year maturity, 5-year maturity, 7-year maturity type of borrowings from companies, essentially, right? The returns will be in the range of maybe, depending on the riskiness of the company, 875 to 975 levels. Okay. So these are just to give you an idea of the types of returns that you can get. And because of this, why you should start to think about investing in fixed income securities. Now, when you think about investing in shares, remember, in shares, you are an owner. You are an owner of the company. Because you're an owner of the company, you carry a certain amount of risk. Technically speaking, we say fixed income instruments have lower risk than shares for two reasons, right? For one thing, in terms of, like, say, for example, in the extreme case that a company goes bankrupt, you would see that people who are creditors of the company or people who have given loans to the company get paid out first. After everybody who's given a loan to the company, whether it be in the form of commercial paper, CDs, debentures, securitizations, or direct loans, right? They get paid out first. After they get paid out, if there is money left, only shareholders get back their money. So because of this, we say shares have residual risk, right? And because of residual risk, shares are categorized as riskier than fixed income investments. And even when you take volatility, shares would probably show you higher volatility. Volatility means how much share prices move up and down. So what is the risk of when you buy a share? What is the risk of you losing money versus making money, right? That volatility of share prices will be higher than fixed income investments. So now I said volatility of share prices might be higher than fixed income investments. Where are we seeing fixed income prices? Here, think about it. You're taking a loan. The company is taking a loan, right? You're giving a loan to the company. So where are you seeing volatility? It's because all of these fixed income instruments that I'm talking about, unlike fixed deposits, that's why fixed deposits don't get categorized under this section. All of these fixed income instruments that we talk about can be traded. Okay. Treasury bills are traded, treasury bonds are traded, commercial paper is traded. So there is a secondary market for each and every one of these fixed income securities. Some of these markets are not so liquid. Some of these markets are very liquid. Like, for example, I told you, treasury bills and bonds are one of the most liquid markets Anywhere in the world, anyway, government securities would be one of the most liquid markets that are there. Okay, and anywhere in the world, fixed income would have lower liquidity in terms of corporate debt fixed income, right? So if you talk about commercial papers or securitizations or even debentures, you wouldn't have as much liquidity as treasury securities, but you can trade it. You just have to find the right buyer and be able to negotiate the price. So anytime that you want to, you will be able to, for example, take that piece of paper and give it to somebody and say, I want to sell this piece of paper to you, which is a promise by company X to pay you this amount of money. And I am I'm looking at this amount of money today. So treasury bills, treasury bonds are traded, but treasury bills, treasury bonds, commercial papers, CDs, securitizations, all of these instruments, other than debentures, are traded in what we call OTC market, over the counter. Over the counter simply means that I call you directly, I call a few people directly, and we interact with each other and we try to figure out what is the price for this security. We negotiate the price of the security and I buy or sell the security to you, from you or to you. Debentures are traded on the Colombo Stock Exchange, listed debentures. So you have a few unlisted debentures that are there, but most debentures are listed and they are traded on the Colombo Stock Exchange. So debentures actually is not a very big market. Like if you take treasury bills, treasury bonds, you can see we're talking trillions. Debentures are about a 400 billion market, but still it's tradable and it's traded on the Colombo Stock Exchange. Just like shares, you simply have to call up your broker and you have to say, I want to buy this debenture, you should buy this company. And I want to, this is the price that I want to buy it at, or this is the yield that I want to get from this debenture. So the broker will then input those details and you can do a trade on the Colombo Stock Exchange. So how you can do this and what price you should ask for, all of these are the things that we will talk about during the course next week. Okay. So let me just show you in trading, for debenture trading, unlike shares, debentures or bonds or any type of fixed income securities actually, you will see work on a certain principle. And that principle is that always in fixed income, tradable fixed income, when interest rates fall, the value of that fixed income instrument, whether it be a debenture or treasury bill or treasury bond, goes up. When interest rates come down, prices of these debentures or treasury bonds or whatever go up. Okay. And vice versa. So if interest rates are coming down, prices go up. If interest rates are going up, prices of these securities come down. And that's a cardinal rule that will happen. So in that sense, one of the interesting things about fixed income securities is, unlike shares, in a share, shares depend on so many different variables, right? If you think of different companies, every single different company has a different thing that's impacting it. So when you want to trade in shares, you need to know so many things about so many different companies, right? If you want to trade in John Keys, I need to know that John Keys is impacted by these things. So these things happening will help John Keys. These things happening is negative for John Keys. Interest rates going up will impact John Keys this way. Exchange rate going up will impact John Keys this way. These are all. And then I look at commercial bank, and commercial bank is impacted in a completely different manner, but completely different things, right? Or reasons. So because of this, sorry, not because of this, but versus this, fixed income securities, whatever type of, all of these different types of tradable fixed income securities that I talked about are mainly impacted by interest rate movement. So what you have to forecast really, or what you have to figure out is which direction is interest rate going to move. If you can figure out which direction interest rates are going to move, then it will be easier for you to figure out, okay, should I buy today? Should I sell now? What type of security should I buy? These are things that you can easily figure out. So again, these are things that we will also talk about a little bit more when we actually talk about the in our class next week. Okay, so just to show you here, I've plotted to show you the type of returns that you can make. I've plotted here the 10-year bond rate. Okay, I told you interest rates came down quite aggressively, right? Because the central bank reduced interest rates quite aggressively because they wanted to help people. They were they were implementing an easing monetary stance. So their monetary policy was to bring down interest rates to be able to promote economic growth. Okay, so because of this, interest rate came down over the last year and a half quite drastically. So if you look at it now, this year I plotted the 10-year bond, treasury bond. Okay, because that's very liquid, or these bonds are liquid, so I can get prices easily. So you can see here, this is on this side, this is interest rate. So interest rates have come down from 1.5 years ago in January, from about 1080 levels to down all the way down to nearly 8%, and now it's up to about 9%. Okay. On the other side, I've plotted the bond price. Okay. When interest rates were around 1075, the bond's price, right, this treasury bond's price was around 120. Okay. Prices went up to close to 155 when interest rates came down close to 8%. And now prices have gone down a bit when interest rates have gone up as well, comparatively, right? So you can see the treasury bond price movement is exactly opposing, exactly inverse to the way interest rates are moving, right? So when interest rates are coming down, bond price is increasing. And when it's going up, one price is decreasing. So you see, in that sense, it's really what you need to forecast when you want to buy or sell debentures, or when you want to buy or sell treasuries. What you need to forecast is, if you want to trade, which direction are interest rates going to move? And depending on the direction interest rates are going to move, what type of security should I buy? So I've just again done one more calculation on a, let's say for example, on 31st of December, I had 100 rupees. Okay. If I had 100 rupees, by today, I would have earned somewhere around, probably looking at it, it's about 20% returns, right? So returns would have gone above 20% and now stabilized at 20%. So here I'm showing you what is a 100 rupee portfolio, what it would have earned over the period. Okay. Versus if the share market, if I invested the same 100 rupees in the share market, how would my 100 rupees have moved in the share market? You can see the volatility, the riskiness of that instrument. Obviously, because of higher risk, you can see that today I'm earning higher in the share market versus the bond, but there are instances where the bond has actually given me higher returns. Okay. So this is just to give you a flavor of what we are going to do next week in terms of what we will talk about. So just to give you an idea, we're going to look at what are the different types of fixed income securities in a little bit more detail. What are treasury bills? What are commercial paper? You know, how they work. And then we look at the features. And then I'm going to concentrate a little bit more, while after looking at each of these different instruments of fixed income that are available, I'm going to concentrate a little bit more on debentures and treasury bonds. I'm going to concentrate specifically on debentures because debentures are available for you to trade easily in the Colombo Stock Exchange. So it's something that is easily accessible to you. But all of those principles are correct even for treasury bonds, for example, right? So I'll talk about the features of debentures, what you have to think about when you're buying, what are the risks that are there in investing in bonds and debentures, how to, for example, how to read a debenture prospectus, meaning what are the things that you should look out for. You know, when you look at the debenture, the trade going through, what are the features that you will see? How to analyze it for investment purposes? Should you go long-term, short-term, what to buy, when to buy? And also market prices, because market prices, some of you may have heard, we have in market prices, we have what we call clean prices and accrued prices, this concept of clean prices and accrued interest, sorry. So we'll talk about that as well. So thank you very much. If there are any questions, I can take a few questions before we stop. But this is what I wanted to talk to you about today.